Welcome back to Bullish. I am Sam Hardy, joined as always by Nick Stenger. Episode number 3 here. We are Stenger Family Office. For the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. We got a great lineup of companies this week. Going to be hitting Generac, Exelon, Coinbase, Amazon, Apple, ConocoPhillips, Papa John's, Occidental, Shake Shack, Wayfair, Cigna, Air Products, Monster, Eli Lilly, Disney. Rounding it out with Berkshire Hathaway. Sorry we missed last week. As you know, it's our weekly quarterly earnings show. I promise we'll explain why in a little bit here. But excited to bring you the clarity, the confidence on these great American companies, a little bit about them, how they're doing, some better than others, as I always say. Remember, everything we talk about here is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. Nick, want to kick off the show by thanking Strive Asset Management for having us out in New York last week. It's why we missed the week. Apologies again, but a great event, due diligence and bell ringing event at the New York Stock Exchange there. Feel free to share your thoughts, buddy.
Sam, how's it going? Bringing the energy today, I see. Yes, we had a wonderful time. We did not have any fun. No smiles were had. In New York City on our trip with Strive Asset Management. For those of you who follow us on social media, you know that we went to the NYSE Ring the Bell with Strive. And just if you're not aware of Strive, you got to check them out. Vivek Ramaswamy's company, who is running for president, he's not the CEO anymore, but we did get to meet the CEO. Wonderful guy, wonderful company. They have great values, really nice people on top of it, really sharp. I mean, sharp as can be. Some of the sharpest minds in the portfolio management, asset management space. I put them in the top 2-3% of people that we meet in this business. So wonderful people. And what they do that's so unique is they offer investors proxy voting aligned with American interests, pro-excellence, rather than some sort of political agenda. And so whether you're Republican or Democrat, you really don't want companies adopting a political agenda. Rather, what you want is them to just be really good at making their stuff, be really good at their company and their services and products. And so that seems obvious, but a lot of these asset managers out there that we will not name, we don't want to call anybody out specifically, but some of the big ones, the biggest on Wall Street, have abandoned excellence in favor of these ridiculous proposals that actually end up hurting the company long term. So that's what we were doing. We were ringing the bell, had a great time. No smiles were had. We did not have any fun, did not enjoy ourselves. No, it was a blast. So it was a good trip.
Yeah, it was my first time in New York City, so feel like I did it right for the first time. Nick showed me the ropes a little, so a wonderful trip. Well, let's hop in it here, Nick. Generac is the first one we're covering. Net sales for the quarter were $1 billion, 23% decrease year over year for them. We saw the biggest decrease in residential sales, down about 44%, industrial sales down 24%. If you're looking at it geographically, domestic was down 28%. Internationally, they were down 10%. So net income down 250%. Adjusted EBITDA down 97%. We've seen the stock drop 28% since the release. Still up year to date, but give us your thoughts there.
Yeah, and Generac, it always kind of surprises me how many people don't know what it is exactly. So just very quickly, what it is for those of you who haven't looked at it before, is it's a generator company, an energy company. It's not energy in the sense of like an ExxonMobil or a Chevron, but it's backup energy, and I think that's going to be increasingly important. So we've owned this in the portfolio for a few years, have done well on it. People who got in at the very top have really struggled. Obviously, the all-time high was in the $4.98 range, almost $500 a share. Now it's $115. It's trading for a pretty high multiple today, which is why some people have panicked. I would not panic. Again, it's not my all-time favorite stock, but I do like it. We've got about a 1% weight in the portfolio here. And again, none of this shows investment advice. I'm just telling you how we've done it and the way we look at portfolio management. The company is trading for $7 billion, the whole company. And they're in the space where I think as we try to go more towards the EVs and electric, and I'm not the biggest fan of that push. I don't think that's really going to work long term. But as we do this more and more, the generator business is going to get more important because it's going to support people's homes when the lights go out. And you saw this happen in Texas and California, all over the place. And so the reality is I think the generator business is going to be strong for a while. The other thing that's really interesting is their commercial business, and this is probably where the growth is going to be long term, is every single 5G tower, believe it or not, has to have a generator at it. And so as we start going more and more towards backup power, having backup sources of energy, I think generator is probably one of the best suited to weather this. I think Kohler has an energy business like this, and there's a couple other smaller companies, but Generac seems to be one of the best players for the consumer market.
Great. Next is Exelon. Revenue increased 13.6%, a little under $5 billion there. Earnings per share was down 40%. Some listeners may have different opinions on this. I don't know, but part of it was strong reliability performance. Exelon's got ComEd, Pico, PHI delivering best on record performance for the second straight quarter. And they've also deployed about 50% of the $7 billion they said they were going to invest into continuing to transform their energy business this year. So, feeling really positive, great results as far as downtimes and how long it's taken to fix energy issues. Stock's down about 3.6%. Since release. It's down 7.4% year to date. And some of these two, a week or two ago is when earnings came out, and we've seen the market drop about 3-4% since then. So worth mentioning that as well.
Yeah, I think utilities companies, there's really not a whole lot to say. I mean, it's pretty self-explanatory for the most part. And what it always becomes is what's the right price to pay for the earnings. And, if you're a regulated utility, you're sort of almost a quasi-government agency. So as an investment opportunity, I wouldn't really look at it as like a long-term growth story necessarily. It's going to chug along. It's going to do fine with inflation. It'll sort of keep up. It's almost, I would almost rather look at it sort of like a bond in a way, where it's kind of like a steady as she goes sort of play. And then you just have to be careful what you pay for the earnings. Right now, the forward earnings are about 17 is the forward price to earnings ratio, which seems reasonable, although the 5-year average is 16. So again, if you pay the right price for this thing, you're fine. We always have a small weight in utilities, but we've never been a big believer in going excessively overweight on utilities, only because it's not growth. It's a value play. You do it for the dividend, and it provides a little bit of a little bit more stability in the portfolio when you go through these down times. But, look at the past 5 years on it. We can pull up the trailing returns. And again, it's going to do about a 7% return, total return, annualized the past 5 years. The past 15 years, though, this is what gets a little bit interesting. The annualized return, 15 years, is 0.5% per year. So again, no growth. It's just you buy it for the dividend.
Great. Next, we've got Coinbase. Number one highlight from them I saw was talking about the decrease in quarterly operating expenses. Year over year, they dropped spending about 50%, a reduction of force by about 30%. Net revenue was down about 17%, a little north of $650 million, and they got their net loss down actually to only $97 million. It was $1 billion the year prior. So adjusted EBITDA was way up 230%. Stock's down about 16.4% since the release, but it is up 124% year to date.
Coinbase is the high-quality crypto play because as all of these other people in the crypto industry have ended up in jail, namely SBF, some of the other people involved in the industry, which we warned people about. We said it's a little bit of a sketchy business. I do sympathize with all the people that like crypto. I don't think I think crypto, the idea of it's great. I just think it's the question is more so, is this a sustainable business model long term as the Fed seeks to try and probably tamp this down. So I don't know. I mean, Coinbase is in this place where they've picked up. The reason they've done well this year is there's two reasons. Number one is they're the high quality play if you want to be exposed to crypto in some way, and they're also the pipes and wires where people are doing a lot of the crypto trading and the crypto holding. Then the second thing is they also fell into this big tech space of just trying to hoard talent for the past couple years with COVID. And similar to Facebook and Amazon and Apple and some of these big tech stocks, they just hired anybody with a heartbeat. And that's all kind of coming to an end at this point where they're like, oh, we don't need 6,000 people. We don't need, 50 people sitting here doing nothing. We need to actually have people that can grow the company. So they're able to easily get rid of some of the people that they hired during COVID. Obviously, we don't root for layoffs or anything like that on a personal level. But if you're a shareholder of the stock, they have a lot of operating leverage here to get rid of some of the excess headcount.
Yeah, no, that's a great explanation there. You brought Amazon up. They're up next. Net sales up 11% year over year, $134 billion. It was all across the board. North American sales up 11%, international up 10%, and AWS was up 12%. Operating income was up 132%. Earnings per share was up to 65 cents. Last year was at negative 20 cents. So nice improvement there. Stock's up about 4.5% since the release.
Amazon, first of all, I will say Amazon, you'd be absolutely bonkers to sell it. I think you'd be absolutely out of your mind. And the reason why is AWS. This is what you buy it for. You don't buy it for them shipping you dog food for $100, like a 50-pound bag of dog food for free shipping. That's a losing proposition, so don't buy it for that. You're buying it for simply the AWS business that powers the rest of it. And I think the retail business, the retail play long term is that they can become a massive big data operation. And if you look at Walmart is a big data play. They have so much information on what you're doing at their store, and then their push into the retail online has been huge. But look at, and this is what's kind of interesting, the past 5-year chart on Walmart now up 67%. Here's Amazon the past 5 years up 38%. Amazon, in my opinion, is not getting the full valuation, the full credit for really the AWS business, which basically prints money. It's the number one cloud play, and everything's going to the cloud, by the way. You'd be shocked, Sam, at how many companies, you wouldn't be shocked because we talk about this, but there's so many companies that are not on the cloud yet. It's unbelievable. I'm talking the biggest Fortune 500s where they still have legacy systems. So buy it for AWS. That's how it should be valued. And then long term, it's a big data play on consumer information. Whether you like that or not, we probably are going to have some more regulation there at some point. But I think the bottom line is the advertising dollars that could come from an operation like Amazon is absolutely massive. That's why they are building the retail business.
Yeah, well, and you see AWS all over the place now, and even, you don't necessarily see all the cloud stuff behind the scenes, but think about all the sports channels we watch and everything now where it's their, graphics that are showing up on the screen. I know they're on the NFL. We brought up Formula One a lot. That's my favorite thing to watch. Every year they've improved that. They're all over the place. That's where, visually I see it the most is on TV, but we know they're behind the scenes with AWS a lot. So another big player, let's jump to Apple. Net sales for them down 1%, $82 billion roughly. If you look at it by segment, by region, Americas and Japan were down. We saw Europe and China with increases. By category, iPhone, iPad, and Mac were where we saw a decrease in sales. The wearables and home products is where there was a slight increase, obviously smaller than the other three. Earnings per share up about 6%, increased net profit margin about 371 bips. Stocks down a little north of 9.5% here. Give us your thoughts on that one.
So Apple is, again, I would lump it in with Amazon as far as you would be nuts to sell it. If you sell Apple, you're going to regret it, I think. Now, again, this is not stock advice, so don't hear me wrong, but I just personal opinion here, and as our client's portfolio manager, I think you'd regret it. I think 5 years from now, you would really look back and say that was a mistake. anytime you think Apple is about to go under or have some serious trouble, they grow their revenue 50%. 50%. That's their growth rate. And the reason is a lot of this is coming from international. A lot of people ask, Nick, why don't you guys believe in international investment? Well, it's not necessarily we write off international completely. It's just we want to own the companies that are going to be best poised to sell into those markets rather than those companies themselves. Well, Apple's got a massive, massive market share in China now, over 23, 24%. And that grew 32% back in 2021. So that's where all the eyeballs are. There's 1 billion people in China. There's 1 billion people in India. That's the next up-and-comer here. So as people get more and more wealthy, they move away from Android, sorry, Google, towards Apple. That's just how it works. And so that's the premium product. That's why I want to be in the premium product. I want to be in the best one that has the biggest that has the biggest growing market share. And that's where I think Apple makes sense. The other thing that nobody talks about with Apple, or very few people talk about, is their services business. And this is the future. You look at Apple Pay, you look at some of the other things, the cloud. I'm paying, I think, I could be wrong, but I think I pay $5 a month for to store my photos online.
Yeah, I do the same.
I'm pretty sure my wife has taken 40,000 pictures of my son so far, and we have to keep them somewhere, and you're not going to delete those. So that's the growth of the business, is the services side. And you remember when Steve Jobs was at Apple, everybody said as soon as he's gone, it's all coming crashing down. Well, that's been like completely false. He's a pretty competent manager. I think you say one of the most competent on Wall Street. And people talk about Apple like it's going to be the next GE. I really doubt it. I mean, there's some serious structural things going on with Apple stock that's going to keep it where it's at for, I believe, for a while. And so, like by the way, if you're in a family where everybody's got an iPhone, okay, and you've got the blue text messages, if you switch to Android, you are now officially ostracized from your family. You're done.
Yeah, there are members I don't include in text messages. I may leave a spouse out if they're, not an Apple user. I hate to say it, but it's true. The other thing that they do is they change up the hardware. I mean, think about it. We're at Lightning now. It wasn't always that. We've got some USB-C stuff. They get you on all the extras that you need to make sure that your product's going to work as, to maximum performance. And so they roll that over every, let's say, 4 or 5 years, and all the old stuff you used to have is obsolete. I got so many cubes in my house I don't use anymore. I mean, I should throw them out, but
no, I think you're exactly right. I think it's one of those companies where it has such a, they talk about moats in investing, right? This is a wide moat company. There's no way around it. And then it just comes down to what's the right price. Sometimes if you get into it at the wrong, PE ratio, you'll temporarily be down. Like right now. I mean, Apple's in a small correction. It peaked at I think it was almost 200 a share. You probably know better than me, Sam, but that's about a 14% correction to where it's at today. I can't see panicking out of this because of a 14% correction. There's been so many times in history where Apple stock has dropped. In 2020, obviously that was kind of the COVID era. It peaked at $80 a share. It went down to 57, believe it or not. You could have bought Apple at 57 in 2020. Yeah, okay, going back to 2018, 55 was one of the kind of close to peak numbers share price wise. It went down to 39. So anytime this thing gets crushed, I think you'd be absolutely out of your mind not to buy it.
Yeah. Agree with you there. Next, ConocoPhillips, revenue down 41%, earnings per share down 54%. CEO Ryan Lance came out optimistic moving forward. They've been making a lot of underlying investments this quarter. They purchased the remaining 50% of Surmont up in Alberta, Canada, completed an acquisition of equity.
That was a nice accent.
Yeah, I don't even know where that came from. Yeah, where the coffee's still starting to hit. So
I liked it for one.
Alberta,
Yes.
and completed an acquisition of equity in Qatar's Northfield South project. So continuing to invest in being able to find raw material. Stocks up 1% since the release, and 3% year to date.
Yeah, Conoco has really been the darling of of the oil stocks, right? And I guess you could almost consider it a major. It's got a much smaller market cap than Chevron or Exxon or BP even. I think BP is now at actually no, it's bigger than BP. So it's really performed very nicely against the broader oil industry. The price return is up 60% the past 5 years compared to 36 on Exxon and 34 on Chevron. So it almost seems like, in a way, it's kind of the growth play in the oil business. That's what we always get a little bit concerned with over allocating. It's not that we wouldn't ever have an allocation to oil. I think right now our core portfolio is about 7% oil, so we're right in line. I think we're actually a little slightly overweight on oil, but that's the only reason why you wouldn't overdo it on these stocks, even if it is Conoco, just because you have to watch the valuation, you have to watch where earnings are coming from. But this thing is really pretty reasonably valued. The current price to earnings ratio is 11. The forward is 10. The 5-year average is 16, which was kind of skewed by the 2020 numbers. But if you look at this thing over the long run, it's trading between 10 and 15 times earnings. Is this thing going to go up another 50%? Probably not. But for a 3.8% dividend, that's not bad at all. It definitely should be a small part of your portfolio, I think, and that's where we have it. I think it's a 1% position for us right now. So I like it. I think it's a good player in the oil space, and definitely is a nice place to get some dividend.
Great. Well, I wish we had brought some pizza in for this one. We are shooting it in the morning, though, so maybe wouldn't have been the healthiest choice. But we've got Papa John's, North American and international sales for them down 1%. Global sales overall was up 2%. Earnings per share was down about 22%. Planning to increase their annual dividend rate here by about 10%, they mentioned. Stock's down 5.6% since the release.
Papa John's tends to be this great play on inflation because when bad times come, people still eat pizza. And in some places in America, this is the best pizza you're going to get. Sam and I were just in New York City, and it ruins pizza for the rest of your life. Now, I think New York City also ruins bagels if you're not getting a New York City bagel every time. Sam disagrees. We can agree to disagree.
We had a lot of carbs, which I was happy about.
I will say I was very upset when I heard you weren't overly impressed with the bagels.
I never said I wasn't overly impressed. I said it was delicious. There's a local place that makes homemade bagels every day right near me. It is Illinois. It's not New York. Sue me, whatever. Don't actually sue me. That being said, it's a delicious bagel. My boys love them. I had one this morning. I had to make sure my teeth were clear for the show. Sue me if you want. I'll go back on that.
I totally disagree with you. I think the New York bagel is the pinnacle of bagels. But you did agree with me on the pizza. I thought that probably...
Angelo's was delicious.
Yes. I think Portnoy gave it a 9.3. I was a 9.8, which maybe, it's not a rookie score, but maybe I just haven't had enough New York pizza to know.
I was diplomatic and gave it a 9.3.
9.3.
I agree with Dave. He's been doing well for himself, so I figure he's got to be doing something right.
Yes. But back to Papa John's. Papa John's, it's a nice inflation play. It's up 72% the past 5 years, and that doesn't even include the dividends. So it's done nicely. I actually think it's a nice little opportunity here. Although the PE ratio is high, do you really want to be paying 36 times earnings for pizza? That's probably going to be the question. But there's obviously some growth opportunities. And the one thing with retail that you always run into is the way they grow is you basically either inflate the cost of your prices a little bit, or you open up a new store. And so if you can inflate the prices and keep your expenses somewhat reasonable, you make more money, obviously, make more margin. But the unfortunate thing with retail is to make more money long term, you have to open up new stores, which is very capital intensive. But where Papa John's really falls in nicely is their stores are tiny. They have these really, really small storefronts. It's not like opening up an Olive Garden where you have 10,000 feet or something like that. So I like it. I think it's good. I just think it just be a little cautious with the valuation at this point.
Okay. Next, we got a Occidental, revenue down 37%, earnings per share down 80%. They did regain investment grade status from Fitch, which we know Fitch isn't just handing out, upgrades to everybody, i.e. the U.S. economy. Similar to other oil and gas companies, positive forward outlook from them, continuing to invest to increase production moving forward. They did see a nice little pop after release. They're up about 2.75% at the moment.
If the U.S. was a company, would you buy it as a stock?
I'm going to refrain from answering that question.
I would buy it. I wouldn't buy I guess.
Is it going to fail?
No. Yeah. No. Could Oxy fail? Maybe. I don't know. I mean, this is one where Carl Icahn, right? He staked his whole claim on this thing, and he's not doing so well right now. Looks like he is having some serious problems. Oxy, I don't know. People talk about it like it's this wonderful story, and I guess it is if you bought it during COVID at $10 and you were able to time that perfectly. But look at the 5-year, no return for 5 years. So I don't know. This is not one in our portfolio for a reason. It's just so heavily tied to commodity prices in a way that like a major is not. So I get a little bit concerned there, and the dividend's just not there. It's a 1% dividend. I think you can do much better. And if you want to be in oil, there's much better options that we already talked about.
All right. That is fair enough. Shake Shack, sales were up all over the place for them. Entire company, they saw an increase of 21%. Their Shack sales were up 17.4%, about $260 million. Total revenue up 17%, adjusted EBITDA up 61%, expanded profit margin 240 basis points. That's sitting at 21% right now. They opened 10 new Shacks domestically, 4 drive-thrus, exciting stuff if you got one of those coming to a town near you. Opened 13 new licensed Shacks in Thailand and China. Stock's down about 7% right now, but they have had a monster year so far.
The tough thing with investing in restaurants is, again, it's so capital intensive that to me it almost seems like you're better off waiting until they built out the capacity, and then it's more of a same-store sales growth story rather than let's open up 25 new restaurants. And the other company that's really had trouble with this is if you're in our area, Portillo's. You've watched that stock just get absolutely crushed. It's a great product. I will say some of the quality, to me, I don't know if you'd agree with this, has kind of declined since they went with private equity and then IPO'd and all that, but it's not terrible. I mean, it's not like it's dropped off so bad that I wouldn't go. I still go every at least twice a month or something like that. So, but paying for that growth now is really tough when it's capital intensive. It's never going to be a SaaS company where they've got the infrastructure built and then it scales super quickly. And that's my only issue with these restaurant companies. Now, when you get to the status of a Garden, which is the parent company of Olive Garden, you start to do much better because then you can pay a dividend. You've got a lot of cash flow. You are a little bit more stable on your earnings. So that's kind of where I would be with the Shake Shack. I don't own it yet. I would maybe wait until they get to the point where they're a little bit more, they're already built out so that I don't have to have my investment dollars going to that. Rather, they can go towards enjoying the same source sales growth over time.
Mm-hmm. All right, let's do Wayfair. Total revenue this about $33.2 billion. Sorry, got a little ahead of myself there. It was a 3.4% decrease year over year. U.S. revenue was down 0.4%. International revenue was down about 20%. But U.S. sales make up 88% of their total sales, so that's why it was only down about 3.4%. Active customers down 7.6%. Net revenue per active customer saw a slight bump, actually. Gross profit up about 10%. Earnings per share up almost 90%. Stock is down right now around 3.7% following the release. It is up 109%, I believe, and it's down 2% today.
Wayfair as an investor does not have just what I need. It is down 46% the past 5 years. It did do very well during COVID when people had nothing to do and were sitting at home ordering furniture. But even then it wasn't profitable. And that's the problem I have with this company long term. If you can trade it, great. Knock yourself out, make a boatload of money. For the rest of us over here in the real world, shipping hundreds of pounds of furniture at zero shipping fees is not a sustainable business model. And even when they had the massive spike in revenue during COVID, they still couldn't get profitable. At least some of these companies during COVID, they had these crazy spikes. They became very profitable. Look at Zoom. Look at some of these stocks. This one just never could do it. So if they couldn't do it then, why would they be able to get profitable now? And there are a million stories of furniture companies. There's a furniture company store graveyard that exists of all these companies that have tried to do this before that just can't make it long term. So furniture is a commodity. I'm not the biggest fan of a commodity business that pays tons and tons of money for advertising and then tons and tons of money to ship things. And then anytime something breaks when it ships, they give you a new one for free. I don't know how they make this work, but it's not. To me, it's just, I don't know. Maybe they have to open up stores long term and not ship directly online, but that doesn't seem like a good idea either. So I'm a little cautious on this one.
If you owned it from March to August of 2020, we'll tip our cap to you. Good job. But I agree with you there. It's up 1,100% in that 5-month window. But anyways, Cigna. Total revenues increased about 7%, about $50 billion. Earnings per share basically flat, $4.92. Overall customer base, we saw a decrease about 7%, largely in part to a behavioral contract they had with New York Life that wasn't renewed. So they actually saw a 40% decrease in behavioral care customers. If I remember correctly, kind of across the board, everything else was fine then. Pharmacy customer base, we saw an increase about 4%. Medical customers increased about 9.5%. If you look at the stock, it's down about 10% since the release.
I've owned this in the past, just personally, not for clients. It made some money on it, made a little bit of money. It did okay, but we're big believers, at least for client portfolios, in owning quality and owning the best name. And this to me is just not the best name. It's not the high quality name. To me, that would be United Healthcare. United Healthcare the past 5 years has just absolutely shot the lights out compared to Cigna, and now Cigna's sort of in this value trap phase. All these insurance companies are having a small pullback this year, but Cigna's having a significant pullback. United Healthcare's down 4%. This thing's down 15%. So, you're seeing some of that quality show itself. And this is what happens is when you buy quality, yes, you go down, but you don't go down quite as much. When you buy the less quality name, when things get tough, you go down much, much more than the general market. So at some point, this thing probably is a buy, but we, again, are trying to buy things for, at least a 5, sometimes even a 10, 15-year time frame. And I just think if you're going to do that, you're better off in other insurance providers. But this is probably one of those trading opportunities. I'm sure that in a year, this thing will be beating the market significantly, but I just, for clients, I want to own the top quality name.
Okay. Next, we've got Air Products, earnings per share up about 2% for them. Net income up 4%. They were able to increase margin about 170 basis points, largely due to higher prices and a slight increase in volume there. But when it comes to sales, overall, they were down about 5%. Americas were down 11%. Asia sales up 10%. And then European sales down 4%. Stocks down about 5% since the release.
Air Products is a really nice long-term play. It's almost like one of those Johnson & Johnson-esque companies, or like a Procter & Gamble, where it really is a nice long-term position for the portfolio. And if you don't overweight it, if you just are kind of in line, maybe a 1 or 2% position, it gives you a nice long-term return. Look at the 15-year on this thing is 9.44% per year the past 15 years. The 10 years right in line with the market, 13% a year, just about. Down a little bit this year. I think that's more so valuation driven than anything else. I don't think it's structurally something that's wrong with the company. So I would put Air Products in this zone of pay the right price for it and you're going to do fine. If you pay the wrong price, just be willing to have some patience and wait it out. But you can't argue with the fact that this thing is it's a plow horse. It just keeps going up over time. It's in a nice segment of the market. It's a great long-term buy in my opinion. But again, eyes wide open. It's similar to Procter and Gamble. It's similar to Johnson and Johnson and some of these great U.S. corporations that can get out of whack on a PE basis. So here you could see some short-term volatility as the market figures out what the right price is. But all along the way, you've got a 2.5% dividend to compensate you for some of that downside, and that's one of the reasons I like it too.
Okay, fair enough. Monster is next. Net sales for them saw an increase about 12%. CEO was very happy, mentioned strong growth seen both U.S. and internationally. I know outside of the U.S. they saw an increase of about 10.2%, which is higher than it's been as far as sales go. 540 basis point increase in gross profit margin for them. They've been able to drop some freight costs as well as the cost of those aluminum cans. So, stock's down about 1.2% since the release, up 13% year to date. And again, let's remember what happened the last couple of weeks in the market. I know it had some strong returns following this news.
Yeah, Monster has actually been one of the best performers in our portfolio over the past 5 years, let's call it, that we've had it, and it's done very well. This is not something you would normally think of, but it seems to me like this. I'm not a big energy drinker myself. I drank them in the past a little bit here or there in college. If you got to pull a late night or an all nighter, maybe you crack open a can of Full Throttle, you crack open a can of Monster, whatever you got to do to stay awake. But this stuff is pure garbage for your body. If you drink it too long, I think you will disintegrate eventually. But people still drink it. I don't understand it. As an investor, it's been great, but as a consumer, I'm like, I don't know. I don't know if I'd want to chug one of those nowadays. I already, I think Billy told us he pounded 2 cases of sugar already in his coffee. I guess that's the equivalent. So instead of having, 4 packets of sugar in your coffee cup, you just have a Monster instead.
Yeah, I don't know how he does that. I prefer black coffee, and I will leave any further comments at that. I've never been an energy drinker. I didn't even drink coffee till COVID when I was stuck at home with a newborn and was like, yeah, maybe I should start drinking coffee. It might help a little bit. So I've been on that train ever since. But let's jump then. Well, any further comments on Monster?
Nope. Other than it is a growth story. That's why it's valued at a 30 PE ratio. It's a growth story. The diluted EPS in 2018 was 88 cents for the year, and then today we are at $1.35. So it's a growth story, and that's why people like it.
Great. Well, speaking of Monster, little dad comment here. We had Monster results this quarter for Eli Lilly. Revenue increased 28%. Net income and earnings per share up 85 and 86% respectively. And what we haven't seen in other companies, which we are seeing with Eli Lilly, and maybe it explains what the stock has done since this news, but 41% increase in revenue. 39% of that was due to volume. Only 2% was due to higher realized prices. Not everybody can say that and hasn't been able to say that. So 4 or 5 drugs here in the U.S. that they credited with sizable increase in volume. I wasn't even going to try and butcher the names of them. But stock's up about 18.4%. Actually up the last couple weeks still. 47% year to date as well. It's up.
Eli Lilly has been, like you said, by the way, I did really like the dad joke because as a dad, you appreciate other dad jokes. So very good. Nice job, Sam.
They're the only other people. Dads are the only people who appreciate dad jokes.
Yes, and dad bods. Well, I guess some people like dad bods, but anyway. So, yes, Eli Lilly has been the bright spot in pharma. All these other pharmaceutical companies are down. They're actually up. And Eli Lilly has this tilt towards diabetes. A lot of their products are diabetes focused, like Trulicity, some of their other ones. So that's where this is probably, it's probably a little under diversified as far as what they really have exposure to, but it's such a big company. Like they don't need to get they're not going to get acquired. Most likely they are going to be an acquirer at some point, which they already sort of have been, but it's a $500 billion stock now trading at a 75 price to earnings ratio. So would you have loved to have it 5 years ago? Absolutely. Today, a little pricey, but this is not a bad one to add to when things get a little bit cheaper. But with these pharma companies, what you can see is all it takes is one little hiccup, and then these things can drop right back down. You saw this with Moderna. It went way through the roof during COVID and that time. Now it's down 41% for the year, still trading at 39 PE. And that's what you could see with an Eli Lilly. They're not in the under-diversified space like Moderna was, but they are very, very concentrated in diabetes. They've got a cancer business, but a lot of their stuff is diabetes-based. So depending on your view there, that could be a risk long-term.
Yeah, and it's really been a rocket ship this last year here. Next, we've got another fun one, Disney. Revenue up 4%, earnings per share up 77 cents as compared to down 25 last year. Win for them was Parks and Experiences. Continued to see great growth there. Media and Entertainment, however, can't say the same thing. Saw decreases in revenue and operating income. If you look at users for Disney Plus, ESPN, and Hulu, you're seeing basically stagnant growth year over year there. We'll just have to wait and see. Continue to see if CEO Bob Iger can kind of turn things around for him. Stock's down about 2.5% since that release.
Yeah, so this isn't a comment about Disney as a company, as a service provider and an entertainment company, so don't hear this wrong. But as a stock, this is my least favorite stock ever. I can't stand it, and they have a massive PE ratio. It's going to go, in my opinion, going to go lower before it goes higher. So maybe at some point we buy it, but I cannot stand the stock. The earnings are really, really tied to China. And like we found out with Strive, they brought up a great point at the due diligence that the Disney China entity is only, what was it, 35% owned by Disney US, and the rest of it, the majority of it, is owned by the PRC, by the Communist Party of China. So I think you really have to think twice before you get yourself into something like this. I don't think this is a company that is supporting American interests like it should be. I think it's a far cry away from what it was, and I think Iger's got a steep climb back to where they were. I don't know if they do get back to that level, you know. And now one of their things that they do have going for themselves is they've got a vertical where not only can they make content, but then they can also distribute that content directly. And that does help them, because a lot of these content providers like a Hulu or Netflix constantly have to be buying new content, which is tough. They don't have to do that. They've already written off the cost of XYZ movie that they made, and then they can distribute that through Disney Plus. So that is a positive. But I just think they've got so much, they've got such a long road to go here back to all-time highs. If I ever buy this thing, it won't be for a long time. Maybe if it gets into the 50s or 60s. And I think I think it was also interesting with ESPN, you know, and like why does Disney own ESPN? Any thoughts there? It doesn't make any sense.
No, I have no thoughts for you there. Do we think that they offload it at some point?
I think they're talking about it. Did they publish anything that was like public on that? Or I don't think so yet, right? But they were definitely thinking about it. But it's one of those media companies. Oh, here's a report. Some analyst thinks that Apple should buy ESPN. That's an interesting idea. I don't know how. Did you
see Apple bought the rights to the MLS? So maybe they're starting to move, which I know there's not that many people that really care about that. But I mean, they saw Messi was coming over and figured they could get in while they should. So I was actually a little upset because I tried to watch the game, and the one streaming service I don't have right now is Apple, whatever it's called, Apple Plus or Apple TV, whatever it is.
Yeah, becoming a streaming company like this, and it's a tough business. There's so many of them, you know, and they don't bundle yet, which maybe that's a bright spot. I listened to the Paramount call, and they said bundling is going to be a really good thing for their business. But you're constantly on this hamster wheel of having to buy new content, which is very expensive, and then finding new subscribers, which I guess maybe you get some international growth there. But if I were in the boardroom of Apple, which I'm clearly not because I'm talking to you, I would, I'd say don't buy it. I don't think you need it. I think you can do, just don't get distracted. And I think that's what happened with Disney is they got distracted with all these different acquisitions. They almost became, I would call them the GE of entertainment. And then they lost focus on what they were really good at, getting people to their parks, and all that. And now
I don't watch any of their new movies. I watch all the old stuff, like all the old animated stuff with my kids. They love. I've talked about Cars on one of the other show. I'm not kidding. I've watched it 120 times this year. One of the 3 movies.
Yeah, they used to produce these stories that just really resonated with people and had great content. And I think they've gotten away from their core competency. And so they've had to raise prices at the park so significantly. If you're a family of 4 like you guys are, Sam, and you go to Disney, I'm pretty sure you're spending $8 to $10,000. I think all in you're at least 5, maybe 6.
Yeah, somebody I follow on Twitter has been talking about it, and if you're looking at a full week, expect minimum $1,000 a day. So,
wow.
If you overdo it, you get some fast passes, a little extra here or there, you're at $10,000 easy. It's absurd.
Yeah. So again, as an investor, I don't like it. I'm not an investor. I won't be for a long time unless it really, really gets cheap and if they really pivot on their strategy.
Okay. All right. Well, let's finish up here with Berkshire Hathaway. Strong quarter for them. Total revenue up just north of 21%. Net income up 180%. Net profit margin up about 170%. Stock was flat, 91 bips up since the release here. They're looking at up about 14% year to date.
Berkshire is such a powerhouse, and talk about a company I don't like that we just talked about. Talk about a company I do like as an investment is Berkshire, and it almost functions as a mutual fund in a way because it's diversified, lots of different business lines, and it's of course going to be. It used to be more of a value play. Now it's really heavily dominated by Apple. That's the biggest holding. And I think they've got some great businesses where they're going to be around for a while. And the cash flow alone is enough of a reason to buy it. What people always make a mistake of, and Buffett writes about this in his annual letter, is don't just look at us for our investment gains or losses. Look at us for our operating gains and losses. And they have very few losses. They have a lot of operating cash flow. That's how you have to value this thing. In the short term, the market reprices the value of their underlying investments and their derivative contracts and things like that. And so what you have to do is just kind of strip that out from their earnings on a quarter to quarter basis and make sure you're looking at the true operating business. So look at their business: $20 billion in insurance premiums earned, $39 billion from sales and services, $2 billion in leasing revenues, $3.8 billion in interest and dividend income alone. And then you go down to the railroad, utilities, and energy business, $20 billion in the quarter in utilities revenue and $5.8 billion in freight, which is only down slightly from last year at its all-time peaks. Services revenues, $1.5 billion in the energy space. And it's a very profitable company. Obviously, I like it. I think this is one that should be in everybody's portfolio. It's a long-term play. The question is what happens after Buffett's gone, and I think they're set up well. I think they'll be fine. I think they're going to be just fine. I don't have any reason to think it's not going to be okay. They've got a good process, and all these top management team, not all of them, obviously we've seen some mistakes, like Disney is one of them when passing the torch, but Berkshire I don't think is going to fall into that camp of screwing up the passing of the torch. So I like it. Again, I wouldn't put 100% of my portfolio into it, but a 3-4% position for us makes a lot of sense. We've got it in client portfolios.
Awesome. Well, thanks for the thoughts there, Nick. Thank you to everybody who's listening. Remember, if you like the show, please subscribe, share with others who you think would enjoy it as well. Next week, we're going to be covering Tyson Foods, KKR, Home Depot, Cardinal Health, Cisco, Walmart, Amcor, Applied Materials, Estee Lauder, Deere & Company and Palo Alto Networks. If you'd like to learn more about Stenger Family Office, visit our website or give us a call, 630-912-8431 to request a complimentary starter kit. You can start a relationship with us for just $1,000, $1,000 starter account. 3 events coming up September 7th at Gibson's in Oak Brook with the legendary Dr. Jeremy Siegel. Nick's also going to be doing a show with him, so would love to see you there or have you listen in. That's going to be just an awesome event. September 20th, hosting a happy hour in Spring, Texas. Our Houston families, we'd love to see you there. Going to be celebrating the opening of our new office down there. And then November 14th and 15th, our annual Investor Day at Hotel Indigo up here in Naperville. Going to be an awesome one. Some great speakers. We're going to have Justin Danhoff, who's the head of corporate governance at Strive. Great story from him. Sure, we'll talk about some of the things that Nick and I learned last week in New York. Thank you all for listening again, and we hope you have a great week.